You only have to look at the 7% declines in bond indices in just the past several weeks to appreciate the risk in risk-free treasuries. When rates move the wrong way, losses can mount in a hurry. We talked yesterday to some of the biggest bond fund managers about how to manage the risk and what factors bond investors need to be watching. So PIMCO CIO Dan Iverson tells me his risk list starts with the idea that inflation is still a material risk. Debt levels are very high. Some investors are demanding default or downgrade premiums. The economy has been strong, and that could push up rates further. You guys were talking about just this stuff in the 6 a.m. hour. All that has been behind the recent sell-off, and he doesn't have tremendous confidence those risks have entirely played out. But Iverson is recommending investors look to extend somewhat the average duration in their bond portfolios. He's taken the duration of the PIMCO income fund with lots of billions of dollars in it up to 4.7 years. Still low, but the highest it's been since 2014. All of that points up a risk that many sitting in cash and short-term bonds may not have thought about. Rollover risk. Those juicy money market yields, they can disappear like that if the Fed starts to cut, leaving investors with the risk of reinvesting at maybe lower yields and wishing they'd locked in the higher ones. I talked to John Croak, head of Vanguard's active fixed income products. He tells me a decision to be all cash or meaningfully overweight cash relative to your long-term allocation is a call that's relying on you and your advisor being able to reallocate towards your long-term equilibrium asset allocation. In other words, staying short is market timing. It's a call on timing. Croak says better to make some of those choices right now while bonds are cheaper. Put a portion of the portfolio in what they call the belly of the curves, 3s, 5s, and 7s. While there could be further losses, they're only losses if you sell. Croak says the biggest risk is the behavior of investors who abandon their long-term strategy because of short-run fears, and they realize losses instead of riding them out.
Silicon Valley Bank shit. If you had gone into a 10 or 15 or
right then
at 3.5, you'd already be looking at 80, probably at 70 cents on the dollar. So we understand that there's reinvestment risk if you don't go long. Everybody knows that. But if you had gone in the last year, because we're at highs now, we're at yearly highs, you're down on every single long bond you bought. You're down right now.
That's true.
It definitely cuts both ways.
It does.
And there's no upside. There might be a little upside. Why would they cut, though, Rick? They're not cutting anytime soon.
Yeah, I really don't see the cut. Now, I know we can look at Fed fund futures and we could draw different conclusions, but I've been a big advocate that if you look beyond 1 or 2 meetings in Fed fund futures, you're really more into a fairy tale than a reality, and I think you need to pay attention to how much change can happen. They're just markets, Joe. It's a fancy 1-month T-bill market, and it changes a lot. One thing I'd like to point out, Steve and I were discussing in the green room, if you look at the spread between our rates and German rates, it's some of the widest of the year, and we're going to continue to exert a force overseas, bringing their rates higher because everybody, of course, looks towards the U.S. Treasury market.
I guess we didn't realize what we had when we had 7 and 8%. We had it forever. We had higher than that, and nobody got excited. No one.
There were guys on the street who would tell me that they would be like 10 years after, the Volcker years.
The band?
They would be looking at the portfolio and see a bond there that was like a 12 or 13% bond. They'd be like, what is this one doing here? And because they hang around for a while, and there were times when you could really be clipping coupons and put your feet up, and you could retire. It's tougher now, but these are somewhat better yields for retirees. Right now, this is a bit of a gift to the baby boom generation for having done absolutely nothing.
It's a lot worse to the youngsters
you got to lock it in.
You got to lock it in. And I really just want to redirect to what this guy was saying. You are not Rick Santelli out there. You do not understand the bond market the way he does, because he does prices and change in his sleep. His wife complains to me about the idea. He's talking in his sleep about the change. You are not an expert. You have to think about, sit down with your advisor and say, here's the money I need over X amount of time, and here's the duration that I can live with. Maybe it's a portion of 6 months and 2 years. Maybe there's some 3s, some 5s, some 7s in there. Keep the duration short, but don't have no duration. And yes, you will have losses if all this stuff goes the other way, like Joe was talking about, but some of it is offset by the short end bond, and some of it you ride out instead of selling.
Ridiculous comment. Well, you get your money back if you hold it. I mean, you're going to be underperforming for 10 years if rates continue higher. And what are you doing calling his wife? And did you know that he's been calling your wife and talking to you?
She's calling me to complain.
I see that red light blinking on the answering machine a lot, and I start to wonder.
But you know what I'm saying, Joe? It's like, yes, you're
no,
right.
I do, but the idea that, hey, it's going to mature someday. Try that with a 100-year bond. I mean, that.
Well, especially if you think, I look at my monthly charts, and if things move in a certain direction, if markets set up in a certain fashion, I do think 13% would be my 10-year call.
Yeah, why?
So
what gets you to that number? Because that is a shocking.
Where's that number from?
No, it is a shocking number. What I do is I went back to 1980. 10-year note yields peaked just shy of 16% in September of '81, and I did some cycle updates. And if you look at, there's basically like a 6.5, 7-year cycle that could bring us into double-digit rates. What would be key there is we would need to close above 7% in the next 2 years. So if that happens, it would signal the next move, which would be more aggressive.
That's technically, but fundamentally, what we'll call that?
That's easy.
200%
Just look towards government.
200 debt to GDP.
Yeah.
We got no way. We got to print so much money.
Military budget and servicing the debt right now, or fighting it out to see who's in the lead. Imagine what that's going to look like in 2 or 3 years.
So MMT doesn't work?
Well, it worked fine if you were a Democrat and you liked to spend, but it didn't work fine for everybody else.
This is what I was worried about with you two sitting.
It worked and works, and the whole concept behind any reasonable, rational thought about MMT is the following. When your growth rate is above your interest rate cost, then it pays for you to go ahead and invest in stuff that has a return. And what is the return? The return is the growth rate that is above your interest rate cost. We are not there any longer, or we're about even, depending upon where you want to put nominal.
Where does the government actually get the R for return, though? That's the part I'm
The R
missing.
for return are roads. The R for return is health. The R for return is...
Didn't we get those in the 50s
education.
and 60s and still have surpluses?
We didn't have surpluses in the 50s and 60s. We had surplus
because of the war.
Right,
Yeah,
because of the war.
you're right.
But no,
a better fiscal
The return
picture.
is defense. The return is all kinds of things that government does that are a positive amid tremendous inefficiencies, amid all kinds of reasons to roll your eyes because it's the government. At the same time, you look around the world and you say, well, where would I rather be living? America's
Well, I don't
not a
know.
bad
Listen,
place.
I agree with you, and I take it back.
And
it's
part
not
of it's the
just
government.
Democrats, actually. It's both sides of the aisle. How disappointing are both sides of the aisle? I don't know.
Steve?
Look, I am not disappointed when government works.
But they're doing things that...
It's an oxymoron.
I mean, you look at the way they're involved in our lives. You really think that's worth the money that people are spending? It's an inefficient way to spend tax dollars.
Which part of which
all
part?
of it?
Which part? No, all of it is not acceptable.
Okay.
You gotta give me something.
If you're really going to yell, I'll let this keep going on. But I don't think it's not.
No, we're not going to solve anything. In the end, $33 trillion in debt, Steve. When our kids are paying
we
70
agree on
cents
that. We
on
agree
the
on that.
dollar
And
for their taxes in about 10 years,
I agree
then
on that.
you talk to me.
And I am very, as I said yesterday, very disappointed in Janet Yellen and the Treasury. I think they should have done a better job. She should have done a better job at trying to rein in the spending, and they should be working to have a plan. Now, we had Jared
they should have
Bernstein.
issued some long bonds a couple of years ago, maybe a lot more.
I think that's one issue but then you'd have Rick complain, or people who he talks to complain, that you don't want the government gaming or timing the market.
No, he just said he wanted to do it.
Is that what you wanted, really?
I don't really like the government trying to time the market, but I think that the alternative might have been worse.